The UK housing market just hit a number nobody saw coming, and it confirms a shocking truth. London is officially losing its title as the UK's top property investment hub. For the first time in over a decade, some areas of the capital are showing negative annual growth, while cities a fraction of the price are skyrocketing. If you're still waiting for the London boom to return, you could be missing out on your next big investment right now. For years, aspiring UK property investors have been told the same lie: you have to invest in London. And for years, first-time and even seasoned investors have been losing money or watching their capital remain stagnant because they didn't know where to look outside the M25. The big banks and global wealth managers aren't telling you the real story because London is their playground. They don't care about your achievable 8% rental yield. They care about their billion-pound portfolios. But today, we cut through the noise. In this video, I'll show you 3 insider pivots, actionable strategies that can help you buy property in the UK smarter and safer than 90% of other investors. We'll expose the core weaknesses of the London market, reveal the 3 high-yield, high-growth hotspots set to outperform London for the next 5 years, and outline the costly mistakes new investors make when panicking about the shift. Stick around, because the most crucial investment decision you make this year starts right now. 1. The trend you can't ignore: the London correction. Let's start with the cold hard data. According to the latest UK House Price Index, while the national average saw modest growth, London recorded the lowest annual house price change in the country, even experiencing outright price falls in key prime and outer London boroughs. This isn't a temporary dip, it's a fundamental correction. The reason is simple: affordability has reached its breaking point.
The average house price in London now sits around £562,000. Compare that to the UK average of roughly £270,000. For an investor, this means your initial capital outlay is more than double for a property that generates a lower average rental yield, often sitting at 3% or less, versus 6%, 7%, or even 9% in the north. When borrowing costs are high, low yields crush your cash flow. The days of relying on 10% annual capital appreciation to bail out poor cash flow are over. The money simply isn't there for the vast majority of local buyers, and international demand is increasingly sensitive to UK tax changes and economic stability. The reality of a higher-for-longer interest rate environment is a poison pill for the high-leverage London market. A typical London buyer is taking out a mortgage that is significantly larger than their northern counterpart. Even a small increase in the base rate translates into a crushing increase in monthly payments in London, forcing prices down as fewer buyers can qualify for the necessary loan amount. In contrast, in cheaper regional markets, the smaller loan size offers a far greater buffer against rate rises, keeping the buyer pool buoyant. We're seeing a sustained shift. Young professionals, the lifeblood of the rental market, are increasingly choosing regional cities. Why pay £2,200 a month for a one-bed flat in Zone 3 when you can own a 2-bed house in Manchester or Leeds for the same monthly cost? The economic center of gravity is moving. Major corporations, from the BBC to Amazon, are relocating significant hubs to cities like Manchester and Birmingham, creating new, high-wage job markets that directly challenge London's dominance. This is driving demand, but crucially, it's driving affordable demand in the regions.
I'm not saying London is dead. The super-prime, multi-million-pound segment remains a global wealth repository. But for the everyday, achievable buy-to-let investor, the focus must shift. If you insist on London, you need hyper-local knowledge. Look at specific regeneration zones like Barking Riverside, or areas benefiting from final-mile Elizabeth Line connectivity that still offer relatively higher yields. But this is fighting for scraps. The real value is elsewhere. 2. Hidden opportunities. The Northern Powerhouse Pivot. Rocket. The smart pivot right now is moving your focus from pure capital appreciation, a London-centric mindset, to strong, resilient cash flow via rental yield. A good yield protects you from market shocks and high interest rates. It allows your investment to pay for itself from day one. This leads us directly to the north of England, where the London correction is creating a regional boom. Manchester is the flagship of the new UK property cycle. It has all the elements London had 20 years ago: world-class universities, massive corporate relocations, Media City UK, tech hubs, and critically, a severe housing deficit. Yields. Areas like Salford Quays and Trafford are consistently offering yields in the 5 to 7% range. Capital growth. Forecasts show Manchester house prices growing by 20+% over the next 5 years, easily outperforming London.
Actionable tip? Look at the periphery, Stockport and Preston, which benefit from Manchester's infrastructure boom but offer a lower entry price for higher yield. Liverpool is often overlooked but provides some of the best cash flow in the country. It's an ideal market for a buy-to-let investor focused purely on income. The city has a huge student population and a rapidly regenerating docklands area. Yields. Certain postcodes in Liverpool are pushing 7 to 9% yields, making them cash flow powerhouses. Entry price. The average property price is often less than a third of London's, drastically lowering your risk and entry barrier. Actionable tip. Explore areas like the Baltic Triangle for young professional rentals, or look at well-managed HMOs near the major universities for maximum yield. We've covered Manchester and Liverpool, but I want to hear from you. Which UK city do you think is the next property hotspot, the one that will surprise everyone? Comment below right now. Your answer might even surprise me. Let's create a community list of future opportunities together. Sheffield, the Steel City, is in the middle of a massive economic shift, benefiting from significant regeneration funds and a booming tech and health tech sector. It's affordable, well-connected, and the price growth has only just started its acceleration phase. The opportunity? Low entry prices and a genuine supply-demand imbalance, with a projected housing unit shortfall by 2035. Actionable tip? Focus on areas near the city center regeneration and those benefiting from the student-to-professional retention rate. 3. Mistakes that cost investors thousands. The shift away from London's market stability exposes new investors to classic mistakes. Don't let the excitement of a high yield blind you to the pitfalls. These are the 3 most costly errors I see regional investors make and how to avoid them. Mistake 1. Ignoring local due diligence. In London, you could often buy on a famous street and be fairly safe. Regional investing is hyper-local. A promising street can be 2 blocks from a terrible street. The mistake is treating a regional city like a single, homogeneous market. The cost? Buying a property that looks cheap but is impossible to rent to reliable tenants because of local crime rates, poor schools, or lack of transport links. This leads to high void periods and costly tenant turnover. The fix is boots-on-the-ground research. You must spend time in the area. Talk to multiple local letting agents, not just the ones selling the property. Check hyperlocal crime statistics. Walk the street on a Friday and Saturday night, not just a Tuesday morning. Understand the planned infrastructure, like HS2 or HS3 routes, but also the local council's plans for new retail or housing developments that could increase competition. Mistake 2. The capital appreciation only trap. The London mindset is ingrained. Buy, wait for the price to go up, then sell. When you pivot to high-yield regions, your strategy must prioritize cash flow. Many investors overspend on renovation, hoping to boost the eventual sales price, but this decimates the monthly cash flow and yield. The cost? Over-leveraging the property. If your rental income is barely covering your mortgage, insurance, and management fees, a weak cash flow, the first time the boiler breaks or you have a 2-month void period, the property is bleeding money. The fix. Run the stress test. Your property must maintain a positive cash flow even if mortgage rates rise by 1.5% and you have a 10% vacancy rate.
Focus your refurbishment on durability and maintenance reduction, not high-spec kitchens that renters don't pay a premium for. Prioritize a good EPC rating now to future-proof against environmental legislation. Mistake 3. Underestimating all associated costs. Many first-time investors look only at the deposit and the mortgage payment. They miss the hidden 4 that can immediately turn a profitable deal into a loss maker. The banks and the estate agents don't stress these enough. The hidden 4 are 1. Stamp duty land tax, or SDLT. For second homes, the rates are high. Factor this in accurately. 2. Section 24 tax changes. For buy-to-let landlords, you can no longer deduct all your mortgage interest from your rental income before calculating tax. This is a game changer for profitability. 3. Contingency fund. You need a liquid cash fund, ideally 25% of the annual gross rent, for unexpected voids, repairs, or emergency legal issues. 4. Property management. If you are investing remotely, a good agent is essential, but they typically charge 10 to 15% of the gross rent. Do not skimp on this fee, but factor it in accurately. The time to act is now. The London correction is a signal, not a disaster. It is the market telling you to change your focus. The cities we've discussed, Manchester, Liverpool, Sheffield, are not future hotspots. They are current, high-growth markets. The window to get in at a comparatively low entry price will not last forever. The time to do your due diligence and make your first calculated pivot is right now. You've got the data, you've got the hotspots, and you've got the mistake checklist. If this video has opened your eyes to the opportunities outside London, there are 2 crucial things you need to do. First, hit that subscribe button right now. If you want weekly, actionable insights on how to make the UK housing market work for you, not for the banks, you need to be part of this community. We track the market minute by minute so you can act at the perfect time. Second, think of someone you know, a friend, a colleague, a family member, who is still holding on to the dream of an impossible London investment. Share this video with them. They will thank you for helping them pivot and avoid a costly mistake. The property market is in motion, and it won't wait for sentimental investors fixated on old news. The biggest danger in property is inaction, driven by fear or misplaced loyalty to an area that no longer serves your financial goals. Smart investors don't wait for the tide to turn. They read the data and sail to where the growth is strongest. The London market is not looking good, but for the smart investor, that's the single greatest opportunity of the decade. Will you be the one who acts on this information?